Picture this. You bought your home 5 years ago. You stretched every penny, signed every form, told yourself it was the smartest financial decision of your life. Then one Tuesday morning you check Rightmove, and the identical flat 2 floors below yours is listed for £150,000 less than you paid. It has been sitting there for 6 months. Nobody has made an offer. That is not a hypothetical scenario. That is the lived reality for tens of thousands of people across London and its commuter geography right now in 2026. London's citywide average property price continues to attract breathless headlines. Economists quote it. Property developers frame it. But averages are the most dangerous number in real estate because they flatten catastrophe into something that looks like calm. They blend the best streets with the worst postcodes until the whole picture looks acceptable from 30,000 feet. Get closer, borough by borough, street by street, and a very different story emerges. In 10 specific areas of this city and its surrounding geography, the correction is not coming. It has already arrived. We are counting down those 10 areas now, from number 10 to number 1, and the picture gets progressively harder to look at the further we go. Number 10. Croydon, South London. There was a moment, not so long ago, when property commentators were calling Croydon the next big thing in London. The street art, the ambition, the promises of a tech revolution anchored around co-working spaces and a cluster of gleaming new towers. Developers spent the better part of a decade building glass and steel in the town centre, Saffron Central Square, 101 George Street, and a dozen others, marketing a futuristic lifestyle to professionals who were priced out of inner London. The pitch was seductive. The reality, arriving in 2026, is something else entirely. The ONS confirmed Croydon's average house price at £395,000 in April 2026, down 2.1% from April 2025. But the borough average conceals something far more severe in the new-build flat market specifically. Zoopla's sold price records for Saffron Central Square show recent transactions completing at £160,000 to £195,000, properties that were marketed and sold at substantially higher prices at the peak of the market. For buyers who purchased those flats at peak valuations, the losses are not marginal. They are structural. The single most damaging factor in Croydon's new-build implosion is the Westfield development that never came. 4 years, it was the anchor of every regeneration conversation, always imminent, always about to transform the high street, always 2 or 3 years away. It never arrived. The existing Whitgift Centre stagnated, commercial energy drained away, and the luxury lifestyle promised by those towers' marketing materials found nothing to attach to. Then came the council's financial difficulties, not once but twice in recent years, which sent a signal to buyers impossible to ignore. When your local authority is effectively a financial emergency, buyers calculate future council tax rises and service cuts into every decision. The co-working revolution turned out to be a few half-empty offices. Remote work finished off whatever remained of the commuter premium. Croydon did not just experience a price correction. It suffered a total collapse of the narrative that had been sustaining its values. Number 9. Barking and Dagenham, East London. Barking and Dagenham was marketed for years as the last affordable frontier of London, a borough on the move, energized by the Elizabeth Line and an ambitious pipeline of new developments. First-time buyers rushed in. Investors followed. Developers built at an extraordinary pace, flooding certain postcodes with near-identical 1- and 2-bedroom flats sharing the same gray laminate flooring, the same patch of communal garden optimistically described as a green space, and nothing whatsoever to distinguish one building from the next. The ONS confirmed the average price in Barking and Dagenham at £360,000 in April 2026, essentially flat from April 2025, recording zero meaningful annual growth. In real, inflation-adjusted terms, that represents a purchasing power loss. But the borough average again masks something far more severe in specific new-build concentrations, where properties purchased at peak prices are now being offered at discounts that would have seemed unthinkable 4 years ago. The defining crisis in Barking and Dagenham, beyond pure oversupply, is the building safety issue. Many of the newer blocks in the area carry outstanding fire safety certification complications. Without a clean external wall survey certificate, major mortgage lenders will not approve finance on the property, which means the buyer pool for thousands of these flats has contracted to cash investors alone. And those cash investors are not paying anything close to asking prices. They are demanding substantial discounts as compensation for the legal and financial uncertainty they are absorbing. Sellers who bought these flats as long-term investments are finding that the only people willing to buy are the ones taking advantage of their desperation. The Elizabeth line was supposed to be transformative. It helped briefly. It cannot cure a market drowning in identical inventory with unresolved safety questions hanging over it like a legal cloud. Number 8. Newham, East London. The 2012 Olympics were supposed to transform Stratford, and to a degree they did. But Stratford is only one part of the borough of Newham, and the regeneration glow never spread evenly across the rest of it. Garrington's 2026 Quality of Life Assessment ranked Newham as the 4th worst London borough in which to live, with housing values specifically cited as a major concern. The ONS confirmed Newham's average house price at £395,000 in April 2026, down 3.2% from April 2025. In the Olympic Park-adjacent new build market specifically, the falls have been far more pronounced. Rightmove data shows the average price across Olympic Park currently at approximately £600,000, but that headline figure includes older, more established properties. The concentrated new build tower stock, built on the assumption that demand from young professionals would be unlimited and permanent, is experiencing something very different. The core problem is a convergence of factors that all point in the same direction. Dozens of developments offering the same view of other developments means scarcity value has dropped to zero. The service charges across Olympic Park-adjacent properties remain punishing, often exceeding £5,000 per year for a 2-bedroom flat, a figure that adds the equivalent of a substantial monthly mortgage payment on top of whatever residents are already paying. The total cost of ownership in some of these buildings has pushed past the cost of renting a considerably nicer property in Zone 1. When that calculation stops making sense, the market breaks. And in significant parts of Newham in 2026, it has broken. Number 7. Bexley, South East London. Bexley sold itself on a simple proposition: London's safety with space, greenery, and a lifestyle that felt suburban without quite surrendering the city. During the pandemic years, when families needed room and gardens and breathing space above everything else, that proposition worked. Buyers paid elevated prices to access it. Now the urgency has subsided, and those same buyers are looking around their streets and asking a question that has no comfortable answer. What exactly are we paying London prices for here? The ONS confirmed the average price in Bexley at £408,000 in April 2026, up 2.5% annually. That modest nominal growth, however, is being entirely consumed by a 5.07% mortgage rate, a 13% energy price cap rise arriving on July 1 confirmed by Ofgem, and inflation remaining above target. In real, purchasing power-adjusted terms, Bexley homeowners are losing ground while the headline figure moves up. The deeper stress is visible in the listing data. A significant proportion of active listings in Bexley carry asking price reductions. Properties are sitting on the market for substantially longer than the pandemic-era norm. Sellers who priced at peak valuations are meeting silence. The brutal truth is that the schools and green spaces in northern Kent are equally good, and the houses are frequently £100,000 cheaper. Buyers are doing that arithmetic now, with a sharpness they lacked in 2021. The commute from Bexley to Cannon Street approaches 45 minutes. When your pitch is suburban lifestyle with a London postcode, you need your transport story to be exceptional. Bexley's is functional at best. For sale signs on Bexley streets are becoming long-term fixtures, and the only people moving through the market with confidence are renters who have no interest in long-term capital appreciation. Number 6. Enfield, North London. Enfield was supposed to be the reliable, steady, grown-up option for North London family buyers. Good schools. Solid green spaces. Reasonable transport links into King's Cross. Developers looked at Zone 4 and Zone 5 and assumed demand would follow the infrastructure. In some pockets, it did. In much of the borough, it absolutely did not. The ONS confirmed Enfield's average house price at £465,000 in April 2026, down 1.3% from April 2025, making it one of the few London boroughs recording a confirmed annual price decline in the most recent data. That figure masks steeper falls in specific new build concentrations and outer postcode areas where the market is most exposed. Homes that sold at the height of the pandemic boom are now sitting with multiple asking price reductions. The problem is that Enfield charged London prices for something that increasingly does not feel like London, and buyers have noticed. Actual Hertfordshire, sitting right on the borough's northern edge, offers bigger gardens, quieter streets, and frequently cheaper entry prices. Transport infrastructure in Enfield has not kept pace with housing growth. Bus route cuts and the absence of a proper underground extension into the heart of the borough have left large sections feeling genuinely isolated. You can reach King's Cross in roughly 30 minutes from Enfield town. But commuting into London is not the same experience as living in London, and buyers paying London prices are increasingly unwilling to settle for that difference. Number 5. Thurrock, Essex. Thurrock sits technically in Essex but functioned for years as a critical piece of London's overspill geography, a place where buyers priced out of Greater London could still, with some creative storytelling, feel connected to the city. The M25, the Tilbury Docks, and a vast logistics economy made Thurrock feel economically active during the pandemic years, when online retail was at its peak and warehouse employment was booming. Developers built to house the workers. Prices climbed on the assumption that the boom was structural. It was not. The ONS confirmed Thurrock's average house price at £329,000 in April 2026, up a nominal 2.1% annually. But House Metrics real terms analysis, accounting for inflation, shows Thurrock homeowners are down 3% in purchasing power over the same period. And in specific new-build postcode concentrations built to house logistics workers during the e-commerce peak, the falls in actual transacted prices are substantially more severe than the borough average shows. The logistics boom cooled, and automation began displacing the warehouse roles that had driven local buyer confidence. The Dartford crossing, essential for anyone commuting between Thurrock and London or Kent, extracts a daily toll in both money and time that registers as a genuine deterrent to buyers who run the full cost calculation. Add rising council tax, aging infrastructure, and a local economy that never fully diversified beyond logistics, and the commuter premium that temporarily inflated Thurrock's prices evaporates. Listings are sitting for months. The sellers who bought at peak prices on the assumption of permanent London-adjacent demand are discovering that assumption has a very specific expiry date. Number 4. Greenwich, South East London. Greenwich carries one of the most powerful brands in London, Royal Heritage, UNESCO World Heritage status, the Thames at its feet. For years, waterfront properties along the river commanded extraordinary premiums, and buyers paid them without hesitation. The combination of prestigious address and riparian views felt bulletproof. In 2026, that certainty is cracking under the weight of costs that nobody factored in when they signed on the dotted line. The ONS confirmed Greenwich's average house price at £456,000 in April 2026, down 1.8% from April 2025. That annual fall is relatively modest at the borough level, but it arrives alongside a set of structural cost pressures that are making specific riverside new-build developments increasingly difficult to own and almost impossible to sell at previously achieved prices. City Hall launched a formal investigation into London's soaring service charges in April 2026, with the probe, confirmed by Greenwich Wire and multiple housing sources, directly citing leasehold developments in riverside boroughs as among the worst offenders. The annual service charges in many Greenwich waterfront developments now exceed £5,500 per year, which when combined with ground rent, buildings insurance, and rising council tax, creates a monthly ownership cost that defies straightforward financial justification. Flood zone insurance premiums have also climbed sharply as insurers recalibrate risk along tidal river properties. Some insurers have declined to quote at all for new policies in certain postcodes. Buyers are walking away in real time when those insurance figures arrive. The properties that are changing hands are going not to families building lives, but to cash investors applying significant discounts below already reduced asking prices. The Royal Borough is losing its premium pricing, and the tide is not cooperating. Number 3. Lewisham, South East London. Lewisham is where this correction is playing out with the slowest and most grinding kind of pressure. Not a sharp crash but a sustained stagnation. The kind that hollows out confidence month by month until sellers are doing things that would have seemed inconceivable 3 years ago. Across parts of Deptford and New Cross, there are documented cases of buyers walking away from deposits rather than completing purchases at current market prices. That is not a sign of a softening market. That is a sign of a market in genuine distress. The ONS confirmed Lewisham's average house price at £490,000 in April 2026, essentially flat from April 2025, recording zero meaningful annual growth. In real terms, after inflation, that is a loss. But the borough average, as elsewhere in this list, is doing substantial work to conceal what is happening inside specific new build concentrations in Deptford and New Cross, where the asking price histories on Rightmove tell a story of repeated reductions over months of unsold inventory. The Bakerloo line extension, the transport project that was supposed to anchor the value proposition for thousands of new build flats in this part of Lewisham, remains indefinitely delayed. TfL confirmed in late 2025 and early 2026 that public consultation would not begin until late 2026 at the earliest, with construction not expected to start until the 2030s. Without that connectivity promise being delivered on any near-term timeline, the entire pricing structure of the new build market in this part of the borough loses its logical foundation. The young professionals who were supposed to fill these towers have dispersed. What remains is a market where investors are competing with each other to find the exit, and where local retail is struggling to sustain itself. Lewisham is not just correcting. It is reassessing what it actually is. Number 2. Medway, Kent. Medway, the cluster of towns that includes Rochester, Chatham, and Gillingham, spent the better part of a decade marketing itself as London's smartest escape route. The high-speed one rail line made Street Pancras reachable in around 40 minutes from Rochester, and for a brief period, that equation made real financial sense. London buyers flooded in, inflating prices to levels the local economy had never previously supported. Investors bought rental properties assuming a permanent flow of London commuters willing to pay premium rents to shave time off their journeys. The ONS confirmed Medway's average house price at £294,000 in April 2026, up 3.3% annually, which sounds healthy in isolation. But that growth figure is deeply misleading as a guide to what is actually happening on the ground. The Medway Facebook Property Group's own market update confirms that monthly price movements have been erratic, up 1.9% one month, down 0.2% the next, up 0.7% after that, a pattern that describes a frozen, low-volume market bouncing around rather than a market with genuine momentum. The fundamental error was confusing a transport link with a lifestyle aspiration. A 40-minute train journey makes London reachable. It does not make Chatham feel like London. When remote work made that commute optional for the very buyers whose demand had inflated local prices, the justification for paying London-adjacent premiums in a Medway town evaporated overnight. The local economy in Medway has never been strong enough to sustain the prices that London demand temporarily created. Buyers who paid those inflated prices on the assumption of a permanent commuter premium are now trapped between a value that has failed to appreciate and a mortgage that has not shrunk. The headline growth figure is concealing a market in very real distress beneath the surface. Number 1. Tower Hamlets, East London. And here, at the top of the list, is the borough that most completely embodies the entire story of London's property excess, its arrogance, its over-engineering, and its ultimate reckoning. Tower Hamlets. Home to Canary Wharf. The glass and steel cathedral of global finance that was supposed to be the safest postcode in the capital for property investment. Prices here are not softening. They are being liquidated. The ONS confirmed Tower Hamlets' average house price at £458,000 in April 2026, down 12.6% from April 2025. Rightmove sold price data for the borough confirms prices are 11% below the previous year and 15% below the 2021 peak of £638,375. Those are not rounding errors. Those are generational losses for people who bought at the wrong moment. The individual case studies are stark. Property Wire documented a 3-bedroom flat in a major Canary Wharf tower that originally sold for £1.4 million and recently changed hands for £950,000, a loss of £450,000 in 7 years, confirmed and verified. That is not an outlier. It is an illustration of what is happening across the Canary Wharf residential market at scale. The collapse is, at its core, a remote work story. The entire value proposition of paying a premium to live within walking distance of those towers collapsed the moment those towers emptied out. International buyers from Hong Kong and mainland China who purchased off-plan 5 to 7 years ago are now discovering their assets are worth a fraction of the price they agreed. They are selling. Service charges in these towers represent a separate crisis entirely. City Hall's April 2026 formal investigation into London's leasehold service charge scandal, confirmed across multiple sources including Greenwich Wire and The Telegraph, cited Canary Wharf area buildings as among the worst offenders, with some developments charging north of £10,000 per year for maintenance and concierge services that residents barely use. When you add council tax on a Band E property approaching £2,000 annually, buildings insurance elevated by post-Grenfell fire safety requirements, and a mortgage on a property losing value every quarter, the total monthly cost of ownership in some Canary Wharf developments exceeds £4,000 before a single pound of principal is repaid. East of the wharf, in Blackwall and Canning Town, developments built on the promise that the financial district would expand eastward are sitting in a vacuum. The towers arrived without the jobs, the retail, or the transport improvements that were supposed to follow. Sellers are not competing with each other for buyers. They are competing with the mathematical reality that buyers have better options across the entire city for less money. Tower Hamlets is not in a correction. It is in a reckoning. London's property market is not uniform. The ONS April 2026 data shows the capital's average sitting at £553,000, a headline that remains extraordinary by any historical measure. But the 10 areas in this countdown tell the story the average is hiding. Tower Hamlets down 12.6%. Greenwich down 1.8%. Newham down 3.2%. Enfield down 1.3%. Croydon down 2.1%. Lewisham flat in nominal terms and falling in real terms. Medway growing on paper and stagnating in practice. Barking and Dagenham standing still while inflation and mortgage costs erode every pound of equity homeowners thought they held. Bexley and Thurrock posting nominal growth that real terms analysis converts directly into losses. The average is comfortable. Reality is specific. And in these specific postcodes, reality is being very unkind indeed. If you own in one of these markets and you have been waiting for the right moment to act, the data is telling you the right moment is not getting more right. If you are a buyer watching from the sidelines, the message is the same as it has been throughout this video. Negotiate hard, take your time, and let the market come to you. Subscribe to the channel. Leave a comment telling us which area you want covered next. And share this with anyone about to make a property decision without looking at the actual data first. Truth over spin. Every single day.